Today, we're going to talk about investing with EdgePoint. Despite EdgePoint being founded 10 years ago, its investment approach has been around for over 4 decades. The approach can be characterized as buying an ownership stake in an excellent business, run by a strong management team, and purchased at an attractive price. A question you might have is, how does this investment approach behave over time? To illustrate, we're going to follow the experience of someone who has been invested in an EdgePoint portfolio for the past 10 years. We'll call her Mimi. Mimi had saved for a number of years and invested $100,000 in the EdgePoint Global portfolio in November of 2008. If you remember, 2008 wasn't a pleasant time for the markets, as the Great Recession was starting. Within the first 2 months, Mimi noticed her investment had grown to almost $120,000. But the tumultuous times weren't over, and her portfolio quickly dropped 22%, or $26,000. Mimi now found her portfolio below its starting value, but thought back to the words of her financial advisor. There will be setbacks along the way, but remember, we're investing for the long term. Mimi soon had a better understanding of what her advisor meant, as her portfolio increased in value over the next 416 days to about $160,000. It was good that Mimi didn't get too overconfident with her newfound wealth, because the next year and a half would test her resolve as market volatility continued. Mimi would watch her portfolio decline 16%, rise 29%, only to fall again by 20%, all in just over a year. After that roller coaster ride, Mimi went to see her financial advisor to see where she stood. After some early success, Mimi's portfolio experienced 3 rather large double-digit declines. Her advisor reminded her that despite these drops, Mimi's portfolio had grown from $100,000 to $140,000 and earned just over 13% per year over the first 3 years. Reassured after her visit, Mimi wouldn't truly grasp the importance of the advisor's early advice, that they were investing for the long term for a few more years. 4 years, to be exact. By the fall of 2015, 1,458 days later, Mimi's portfolio was now worth about $370,000, up 165% from the last big 20% drop. During Mimi's 7th annual portfolio review with her financial advisor, she was reminded that there hadn't been a market correction in a number of years, and it was a matter of when, not if, another occurs. It was very timely advice, because Mimi's portfolio quickly dropped 14% as concerns around the growth rate of emerging market economies was being questioned in the late summer and fall of 2015. This translated into a decline of over $53,000 in her portfolio, more than half of her original investment. Mimi took a deep breath and reminded herself that she was investing for the long term. This correction might be short term, like the others she had experienced. Seems logical. The next 2.5 years proved her right, as her portfolio increased again, this time by $217,000. She was stunned that her original investment of $100,000 had grown to $535,000 in 10 years. When the market dropped 17% in the fourth quarter of 2018, Mimi's portfolio declined $87,000, more than her annual salary. But Mimi was far less worried than she thought she would be. 10 years had given her a few more gray hairs, but the 4 previous large declines had also given her perspective on being an investor, or should she say, a long-term investor. We will say goodbye to Mimi for now, as at the end of June her portfolio had rebounded once again. In the world of investing, Mimi has learned that nothing lasts forever, both market upswings and market corrections. The only thing we can be certain of is the roller coaster will continue, and that both economies and successful companies expand over long periods of time. And, if history is a guide, investors that manage to stay invested for long periods of time find their portfolios expand as well.